Today on Think Smart with TMFG, Mike and I are going to be discussing the new mortgage rules for first-time home buyers in Canada. Mike, we all know that the Liberal Party is behind in the polls.
Not having a good year.
They are not having a good year. And I like to think their current change in the mortgage rules is kind of like Justin Trudeau pulling the goalie in a hockey game where you're behind by a couple of goals with 2 minutes left.
Yeah, they seem to be behind it by a lot.
And they are. So I thought what we should do today is just touch on some of the things that they have changed. And is it a good thing or bad thing for these first-time home buyers who are trying to get into the Canadian market, the Toronto market, the Vancouver market, you name it. They're trying to get in given the current environment going on with interest rates and home prices and home inventory.
I guess they have solutions, but we don't know if they're ideal solutions.
So let's talk about one of the biggest changes. Traditionally in Canada, we've had a 25-year mortgage. So you can do your mortgage for 10 years, 15 years, 20 years, or 25 years. A number of years ago, we tried to move to that 30-year mortgage. Not many people took it up. But they've come back and they're allowing that for first-time home buyers. And I think it's interesting. I'm going to go through some of the math, and I don't like the math on it, but the premise behind it is the longer you stretch out those mortgage payments, the lower you can pay per month.
I guess some of the problems with that are coming up in this is, a lot of times we think of first-time home buyers as 25-year-olds, right? They have tons of immigration coming to Canada, and these people are not 25, right? So you have a first-time home buyer comes to Canada, they're, 35 or 40, and they want to buy a home. What are you sticking with them?
Right.
They're 40 years old. You got to Canada, the land of the prosperous and everything, and they say, okay, get your first home mortgage. You're 40 years old, and you're 70 before it's even paid off.
And they don't necessarily know that that's a bad thing.
Yeah.
Maybe a 30-year mortgage is standard. In the States, a lot of people take 30-year mortgages. Now, they have a big advantage because those mortgages are tax deductible. So that's part one. Part two is they have now allowed the minimum down payment so you can buy and get an insured mortgage for a home that's worth up to $1.5 million. Before, it used to be $1 million. So they've increased that by $500,000. I'm going to go through some of the reasons why they've done that. But the simple reason is,
prices have gone up.
Housing prices have gone up dramatically since the pandemic.
Understandable.
So now homeowners are able to get an insured mortgage with almost as little as, let's call it a 5% down payment. Okay? So you could buy a $500,000 home with a 5% down payment. The minute that home is worth more than $500,000, let's say it's worth $1 million, it's now 5% on the first $500,000 and 10% on the next $500,000, and that goes all the way up to $1.5 million. So it's 10% on $1 million, 5% on $500,000 for $1.5 million house.
It can be a bit dangerous at times, can't it?
Here's what's interesting. All buyers, including investors, will have access to this 30-year mortgage. So it doesn't just apply to first-time home buyers, but the insured mortgage really applies to just first-time home buyers. Let's go through. The Liberal government is calling this their boldest mortgage reform move in decades. So they really think this is a big game changer for the mortgage market for first-time home buyers in Canada. Mortgage loan insurance currently allows Canadians to finance up to 95% of the purchase price of a home. So if you're able to do that math, and I've done the math, and I'm going to go through an example, you could, in theory, get a really big mortgage. Is that a good idea?
Yeah, I always, debt is always the enemy of success many times, and you watch that over time. Anyone who has no debt, I find never gets in real financial problems. You find throughout their life. That's the one advice I can give to everyone. Debt's not a great thing. Particularly, we have good debt and bad debt. And as you referenced before, in Canada, mortgages are not tax deductible, so it's not good debt.
So I went through a sort of a list of what I thought are some of the things that should be considered. What will the additional interest be that homeowner has to pay over the life of that mortgage. So if it goes from 25 years to 30 years, how much additional interest will that be? How stretched will that homeowner be after they have to pay all that interest? Next up is what sort of income level will they need to have to make those, you can't spend 70% of your income on your mortgage payments. Typical number is 35%, 30 to 35, so 35 would be at the higher end. And what that means is if you're making $100,000 household income, 35% of that is $35,000 a year in mortgage payments, combination principal and interest. Let's talk about housing prices. Average home price in our country is $650,000. Average home price in Toronto, not dissimilar from Vancouver, it's over $1 million. It's almost $1.1 million. So that's why they've made this move to $1.5 million. And Mike, I think why have they gone to $1.5 million versus 1.1 if the average price is 1.1? As you said, we've got a lot of new Canadians coming in, some of them with money, and they want to be able to buy that first home in our country. And maybe they don't want $1.1 million home. Maybe they want $1.5 million.
Well, maybe they have 3 kids, right? We always think of first time. Again, we're going to a couple that's about to have kids. We have new immigrants coming that have families with 4 or 5 people in them.
So let's go through the scenario that I talked about. So home buyer comes in. They want to buy a home in one of the big markets, Vancouver, Toronto. Those happen to be the most expensive markets to buy in. The cost of the home would be $1 million. So to get insured mortgage, they only need, as I said, 5% down on the first $500, so that's $25,000, and they need 10% down on the next $500, $50,000. So they could $75,000 down. So hopefully, if you're going to buy a home, you can come up with $75,000 as a down payment. If you can't, you probably shouldn't be even looking at a house yet. Let's assume they take one of these 30-year mortgages, and they get it on a 5-year term, which means whatever interest rate you're going to pay, you can lock in for 5 years. I mean, you could go with a variable, but let's say they're going to lock it in for 5 years. I went online, and currently today you could get that mortgage for about 4.4%. You might be a little more at the big banks. You're probably closer to 5%. But if you did your research, you went to a mortgage broker, you could probably get it at 4.4. You following me so far? Okay. So next up is they're going to allocate 35% of their household income, 2 partners together, whether it's husband, wife, partners, whatever it is, 35% of their total household income to those mortgages. Insured mortgages are going to cost them, on a 30-year mortgage, a premium of about 20 basis points. So if they're doing a 30-year mortgage, it won't be at 4.4%. It would be at 4.6%. So that changes the math a little bit.
So let's explain just to the audience what an insured mortgage is. So if you're taking what we call a high ratio mortgage, which would be, I guess, under 25% down. I think those are the rules. There's something I'll call Canadian CMHC or
CMHC insurance.
Yeah. So there's insurance, and what that insurance is, usually you buy insurance for yourself. Unfortunately, this insurance is not for yourself. This is insurance that you have to pay for the bank.
Right. It's the bank's insurance. It protects the bank.
It protects the bank. So it's a very odd type of thing. So you're buying an insurance policy in case you can't pay to pay off the bank.
So the bank is willing to lend you the money, even though you're only putting 5% down, because they're sort of covered with this insurance. So it kind of lets the bank off the hook a little bit on these high ratio mortgages, let's call them.
Very low risk. We always talk about why Canada did so well back in 2007, 2008. A lot of it was because a lot of the mortgages were protected. We didn't have the same issues as the States.
So let me go through the first example. I'm going to do the traditional one, which is 25-year mortgage. It's $1 million home. We're going to put that $75,000 down, and we're paying 4.4%. Monthly payment would be a little over $5,000, so $5,070. Yearly, it's about $61,000. Total interest over the lifetime of the mortgage is just under $600,000 over that 25 years. That's a lot of money. Okay? Household income, and this is where I have trouble with this whole plan. If you use that 35% factor, household income has to be $174,000. There's not many Canadians with household income over $174,000. There's some
that are first-time home buyers,
right? Like household income. That's a really high household income. So let's go to the second example. I'm going to do one of these 30-year mortgages. And $1 million down, the interest rate goes up a little bit to 4.6%, and we're talking about $75,000 down again. Your mortgage payments drops a little bit from $5,070 to really $4,700. And it's about $360 a month less. Over the course of a year, it's going to save you a little bit. It's going to save you about $4,200 per year.
Yep.
But here's the kicker. The kicker is the cost difference over the lifetime of the mortgage. It's going to cost you, for that extra 5 years, an additional $161,000 extra.
So who gets that money?
The bank. Well, the bank.
Yeah.
The bank has to. They don't get all of it, but they do get all of it. But they've got an expense. They've got to pay someone to, lend the money out. But
I guess so. But Jesus, the banks have a good profit center there because the government has just increased their profits through legislation.
So there's some good things. So I looked at what are the payments if you go from this 25-year to a 30-year. Payments are going to be about 7% less per month. Okay. The income requirement is going to be about 7% less. But your interest payments over the course of that period are going up 18%. So there's a big disconnect. And who's going to benefit from this?
The banks.
The banks.
And when you talk about, they haven't really made it more affordable. They went and just spread out the cost of it, right? So I guess you can consider it from a year-to-year basis, it might be affordable, but over the long term of paying off your house, it's less affordable.
So you and I are financial advisors. Is it good for a client to be paying $161,000 more in interest over the course of the next 25 to 30 years? That's a big number.
Yeah.
So what's today's market look like? What are some of the things that you see in today's market? How are resale prices right now?
They've been flat to down a bit in the last, let's say, 6 months.
Sales are a little bit lower, not much, 2% lower. As I walk through the neighborhood, I'm seeing houses are staying on the market longer. There was a period where there was barely anything in the market, and the for sale sign would go up, and the next day it would say sold. Those days are over.
Yep.
So it's taking longer. At the same time, our national unemployment rate has gone from 5.5% to 6.6%. So something's going on there. So it's an interesting market.
It's a difficult thing. We talked about why the markets move before. I was listening to an interesting podcast on this. And the one thing that goes on is most people in Canada, their biggest asset is their house. I mean, when you look at their whole situation, that's when you say, what's my net worth? Your house will make up a large portion of it. And when you get into the idea of what people want to happen with housing prices, most people who have a house would like the house prices to go up. Feels good, right?
Right.
Your net worth goes up. So everyone wants this. So when governments want to get elected, their goal is to keep housing prices going higher. We keep on talking about lowering housing prices. That doesn't get you reelected.
Make them more affordable.
Yeah. So they went to this, and all this is doing is continue to go and throw fuel on the fire of house prices into the future, because as you do this, you're going to continue to bring house prices up.
You've made it easier to buy a house. In theory, that increases demand. Supply hasn't necessarily increased. So if demand's higher than supply, price must rise.
Yeah, but there's always an end to it. We've had this great idea where people talk about theories and things like that, right? And you were talking before, you can afford between 30 and 35% of your income to pay for a house. And then I hear people saying, well, the housing market's going to continue to grow at 8 or 10%. I say, well, what's inflation going to be at? They say 3%. And I say, well, that's impossible. They say, well, that's your theory. I said, no, it's not a theory, it's math. Because if you continue to take this and you say that your housing affordability, if you're spending 35% and that cost is going to grow at 8% and your wages are going to grow at 3%, there is no possible formula that could make that work. Eventually 100% of your house, then 120% of your whatever you make is going to go to your house, which we know is impossible. So there is an impossibility mathematically for housing prices to continue to grow at an exponential rate of inflation. It just can't continue. And people want to say it isn't a theory, it's reality.
So Here's my take on the main problems with the strategy. Number one, taking out a 30-year mortgage is equivalent to being in debt for most of your working career. I'm 32 years as a financial advisor. Now, I had a short career for 5 years before that, but at least 3/4, 80% of my working career, I'm going to have a debt, non-deductible debt. You've likely, because of this easy financing, bought a house worth more than you should probably spend. You bought a bigger house than you should have, or a more expensive house than you should have. And finally, you're doing this in a period of relative stability in the Canadian market, relatively low unemployment rate.
Yeah.
What if that unemployment rate starts to change? We actually go into a recession or something. Could that household income drop? You might have two income earners now. What happens if one of them loses their job for 6 months? Dramatic change. So there's got to be some better solutions. I never like, when people poke holes at everything and never come up with solutions. So I did some thinking on this. What would I do if I was the government? Right now, I've talked about this in previous podcasts, we've got some empty houses in our neighborhood. In fact, the house next to us has been empty for 6 years. Right now, the tax that they have to pay is 1%. If it goes into 3 years or something that they've been there, it's 3%. How about just make it 10% if it's over a year? 10% tax. Let's see what that does. I'm hoping it brings some of those houses back onto the market. This is going to be a tough one. I'm going to go there. I had dinner recently with someone who used to own 27 homes.
Yeah.
And I said, what about if we cap that? What if we say the most number of homes you can own in a corp, personally, but household, extra homes, whatever you want to qualify it, is 5 or 3. Right now, you could have 25 extra homes. That takes homes out of the market. It puts them in the rental market.
Yeah.
But we're not talking about renting homes here. We're talking about buying homes. So all we're trying to do is up the number of homes for sale. What does that do, Mike, if you up the number of homes for sale?
Yeah, then you have more. Prices should come down.
Prices should come down. Next up, renting in big cities like Toronto and Vancouver, global cities, is common. If you go to London, New York, you're not buying a house. If you do, you're buying it in the suburbs.
You rent a flat.
You rent a flat.
That's how it is.
We think it's easier to build more homes. What the government has to do, and we've seen the Alberta government do this, make it really easy to build a home. You try getting the regulations all in line to build a home today in Ontario.
The red tape infrastructure that they've put in place now is for our clients that we know that are involved in the build industry. They told us it's almost impossible to make money building homes now just because of the government loopholes you have to go through.
Next up, immigration. Touchy subject, I get it. Canadians are divided. Most Canadians want immigration. We just want it slowed down a little bit. Let the housing market catch up to the current immigration that's going on in our country. Government has done some good things. Number one, they launched the First Home Savings Plan. You can put $8,000 away. It grows tax-free. You can put $8,000 away a year, $40,000 in total, and you can deduct it from your income.
There's no problem with it. There's no negative. It's like the tax-free saving account. There's no negative. The first-time home savers plan, there is no negative to it. It's a great idea.
And if you got a partner, you could each do $40,000, so that's $80,000. Back to our example, you've got enough for that first down payment. Number two, they have increased the amount that you do in the Homebuyers plan. So they have done some good things, but they haven't done enough to make more houses available in the market. And I think this 30-year mortgage is a mistake. I'm all for these insured mortgages. I think they're good, but you have to understand the banks are the ones that are really benefiting. They're taking on these risk-free mortgages with an extra 20 basis points, and really they don't have any risk.
Yep.
That brings us to the end of another week. Thank you for joining us. This is Rob and Mike with Think Smart.